Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at a potential bank takeover that could reshape Europe's banking landscape.
Plus, we'll discuss why German automakers are now sinking deeper into an industry-wide crisis.
But first, we dive into U.S. politics. Vice President Kamala Harris and former President Donald Trump are in a closely contested race to be president, and we're now less than 2 months away from Election Day.
Recently, Bloomberg Intelligence took another deep dive into the U.S. presidential election. The research looked at how a potential Harris or Trump presidency could impact different sectors and policies in the U.S.
For more on this, we were joined by Nathan Dean, Bloomberg Intelligence Senior Policy Analyst.
We first asked Nathan to break down some of the sectors that could be impacted after the U.S. election.
And some of our key sectors to watch were like renewables, tied to the Inflation Reduction Act. There's a lot of tax carrots, if you will, in there that are spurring renewable investment, especially in CapEx in a lot of GOP states. Others involve the banks. You know, the Basel III endgame, a proposal that would increase capital requirements around 9% for the investment banks. If President Trump wins, that may not go forward. Other things are global manufacturers due to the tax changes. Healthcare, there are $25 billion in Obamacare subsidies that are up for renewal next year. And finally, big tech. You know, if Kamala Harris wins, you're going to have a continuation of the very stringent M&A antitrust authority that the Biden-era regulators are putting on big tech. But if J.D. Vance's idea of economic populism gets into the White House, you could see a Republican president also be very skeptical of big tech. So a lot of what ifs, but a lot of scenarios in which those industries could be heavily impacted.
You know, I listened to former President Trump's economic plan at the Economic Club of New York. I don't know, I had a hard time making heads or tails out of it, but I guess it was lower taxes, higher tariffs. Is that kind of the basis of his economic, platform?
Yeah, I think that's a really good point to point out, because I think it's almost like a phase one, phase two type of deal if President Trump wins. Phase one is tariffs. You know, this is something that he can do. The power of the presidency is a lot more powerful there. And so, the first half of 2025, you could see a lot more tariffs coming in. Now, I would argue that a lot of these tariffs are negotiation ploys. You know, if he holds up an executive order and says, I'm going to sign a tariff, there's probably language in that executive order saying 270 days from now, it won't go into fruition until then, because you're going to give the opposite side multiple times to negotiate. But it's certainly something that he's comfortable with, and I think, would easily put out if he feels that it's necessary. But then the tax reform debate is what's going to come next, because at the end of 2025, those Trump-era tax cuts for individuals expire. Now, President Trump has said 15% corporate tax rate. I'm not sure he'll be able to get that. You know, he's going to have to negotiate. We've seen a little bit of statements from House Republicans saying, maybe we should go down to 20 or 19 or 18%, but being able to pay for that 15% is going to be somewhat difficult for these deficit hawks. So, but there's a lot of provisions of the Trump-era tax cuts that have already expired for industry, and I think President Trump is going to try and institute those. So at a large level, think Trump 2.0 is going to do another version of the same tax cut.
I literally remember having the exact same conversation in 2015, 2016, like the phase two, how you get it done, etc. So what's interesting to me, though, is the lack of response, though, in, say, high tax companies versus low tax companies, like the things that would make sense because those policies are so different, say, on corporate taxes. Are we seeing that reflected within market moves?
You know, I think so, but I've been talking to a lot of investors over the last few weeks, and a lot of folks come to me and they say, we just really don't know what's going to happen on tax until we know the makeup of Congress. And the reason being is that if President Trump wins, but the Democrats take the House, pretty much all of his tax vision, if you will, is going to be curtailed, negotiated, and a lot more restricted. Now, if he ends up winning the House and the Senate, they can use reconciliation to essentially bypass the Democrats, and they have a very broad net that they can cast. So a lot of people that I've been talking to have saying, look, we understand the Trump-era desires, and we understand that these broad deficit-inducing tax cuts potentially could be on the horizon, but we're not excited about it just yet because we need to see how the House and Senate races play out.
What is the thinking currently in Washington, Nathan, about how that will play out in Congress?
Well, look, I mean, if you go to the function on the terminal WSL election, you can see all the data there. But I think, when it comes to the Senate, that's going to be somewhat very difficult for the Democrats to control, because right now it's 51-49. You're going to lose West Virginia because Senator Joe Manchin is retiring. So now you're at a 50-50, and the Democrats essentially have to run the board just to keep that 50-50. Think of Senator Sherrod Brown in Ohio, Senator John Tester in Montana, Senator Jackie Rose in Nevada. So assuming that if the Democrats lose one, the Republicans are most likely going to take the Senate. And if President Trump wins, then obviously allow him the ability to put in judges and his regulatory leadership. When it comes to the House, I've seen polling on both sides, but my general view, and this is just my personal view, is that whoever wins the president also wins the House.
Our thanks to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst.
We next take a look at the coffee chain Starbucks. Starbucks CEO Brian Niccol officially took office this week, and expectations for him are high.
The company's shares soared 18% after it named Niccol CEO, and this comes after 2 consecutive quarters of sales slumps. For more, we were joined by Micheal Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
We first asked Micheal just how long the market gives Niccol before judging him.
It's tough to say, right? I think really it's going to take some time. You don't turn around an aircraft carrier on a dime. Starbucks is a behemoth of a company. So I think the market gives him some time. He's got a phenomenal track record, right? What he's done at Taco Bell and then Chipotle obviously were very impressive. And he's really, the first thing he's going to do, I think, is just try to change that culture, right? Bring in a culture of transparency, accountability. He's going to talk about hard work and compensating his employees for doing a good job, because those are some of the things he talked about changing at Chipotle on his first earnings call there. So all that stuff's going to take a little bit of time, and because of his track record, he'll get a pretty long leash, I think.
What are the challenges facing this company? Because just as a consumer, I mean, the Starbucks on Route 35 in Wall Township, New Jersey, they do a great job. People are great. It just works like a charm. Store's in great shape. The one in Summit's good. It's always packed. What do they need to do here? I don't think anything's broken.
It sounds like that location is doing pretty well, but they have thousands and thousands of locations across the globe. I mean, in the U.S., operations is a big issue. Drink orders have become more complicated. Digital orders have kind of changed the experience for the in-cafe customer, right? Like it became popular because the baristas knew your name, right? And the level of service was phenomenal for a chain of that size, right? And through digital ordering and these very complicated orders, they've lost some of that, right? And so operations, they're losing a lot of orders because people are trying to place them on the app, and the wait times are kind of obnoxious at times, right? And so I think operations is going to be his primary focus. Running the best cafes possible is really going to be job number one. But there's a bunch of different issues. Operations is just one of them. Politics has been an issue, right? Starbucks has always been a brand that kind of puts their politics in your face, and I think Brian Niccol is going to want to step back from that, right? Because of all the issues they've had with their customer base, right? People haven't been happy with there's been some boycott talks online about their stance on the Israel-Hamas war, about their stance and how they've handled the union negotiations, so that's a big thing. And then, we think eventually, once they have the stores running really, really well, they're going to start spending some more money on marketing. Maybe not a ton of money, but we would expect them to start spending on marketing. It's not something that Starbucks has traditionally done, but it also wasn't something that Chipotle had traditionally done, and it's been paying them dividends now for a handful of years.
So the thing with Chipotle, though, if we just and maybe Paul can attest, is that there's a menu and it's basic, like there are add-ons, right? But it's a basic menu. Starbucks menu is explosive. They can't even have all the options up on the ordering board because there are just too many. So does working with operations and getting that better mean they have to pare back their menu and get back to their base?
Yeah, probably. We had been critical of the previous management team because they kept rolling out new menu platforms, and then in the next breath talking about improving throughput. But you can't have both. So we fully expect them to pare back this menu, make it easier to execute in the cafes, right? Make lives easier for their employees and get the orders out faster. So yeah, I think that's going to be a major part of what they do going forward.
I mean, Bloomberg had a story from last in 2023 where, I mean, the variations, if you add up all the potential options, there's like billions of different types of drinks that can be made.
Oh, yeah.
You know, so it's just out of
And there's
control.
like the cold drink, there's the tea, there's the refreshers, then there's the frozen refreshers, and the blended refreshers. And I know that's because my daughter likes those things.
Yep.
But sometimes you get them frozen, and then sometimes they're not. It's very complicated.
I know. I don't know how they do it. My power, my hats off to them. All right, let's step back and look at the restaurant space in general here. You've got some research out recently. Restaurant promotions, marketing heat up. That's not what shareholders want to hear, do they?
No, but restaurants are kind of desperate right now to get some traffic into their stores. Low-income consumers' spending has been very weak. This seems to be spreading to the middle-income consumers, right, based on the industry data that we've seen, which showed an improvement last month in August, but it was still negative at casual dining restaurants, at family dining restaurants, and at quick service, right? And so they bounced from that horrific July numbers that we saw, but still are negative. And so, yeah, restaurants are trying to do whatever they can to bring, those low-income consumers and middle-income consumers back into their restaurants. Just for example, it was, I think it's 35 out of the last 37 quarters quick service chains have had negative traffic, right? And so that's not a sustainable type of situation when you have same-store sales rising because your prices are going up, but traffic continues to decline. Eventually, there's a tipping point, and that's what we've seen this year.
So to that point then, which ones do you have faith that can maintain some kind of margin and also grow their top line?
It's some of these chains that have a big gap on pricing, in terms of, they've been pricing less than their competitors, right? So if you're providing a lot of value, and value can be two ways. It can be a better price, but it also can be a lot more food for what you pay. But some of these companies that people see value at, Wingstop, Chipotle, Texas Roadhouse, these are all of the chains that have been outperforming. These are all of the chains that have been able to drive traffic, and a big part of it is being priced below competitors. Wingstop's raised prices about half as much as their competitors, and on their last earnings call, they credited that as a big reason for their phenomenal quarter.
Our thanks to Micheal Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
Coming up, we'll break down Apple's rise into the most valuable company in the world.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We look next at European banks. This week, we heard that UniCredit has built a 9% stake in Commerzbank and plans to enter into talks with the lender.
This raises the possibility of a full takeover that could reshape Europe's banking landscape. For more, we were joined by Philip Richards, Bloomberg Intelligence Senior Analyst for European banks.
We first asked Philip to break down the possibility Commerzbank will actually be taken over.
It's an interesting one. As you say, this is not a new rumored deal. It's been going on for literally well over a decade now in terms of big cross-border deals. But the simple case remains that any big cross-border transaction among European banks still hasn't happened in the last 15 years since the crisis. Will it happen now? Yes, it's a possibility, but there's still a lot of hurdles left. In terms of will the German government allow them specifically, what it would flag is the German market is very different to all the other European markets. They've got a very big cooperative or mutual society. They've got the Sparkassen, the Landesbanks. So actually the private banks, Deutsche Bank and Commerzbank, are a much smaller part of the overall market, and therefore could they take out the second biggest German bank? I think it is possible on that front.
Would it be a good deal for UniCredit? I guess what I'm asking is how good of a management team, how good of a franchise is UniCredit?
Well, is it a good deal? I mean, that will come down to the price. And one good thing about Commerzbank is pricing is at a very low level. In terms of what you get for it, yes, the earnings have been very, very weak for the last 15 years, one of the lowest return on equity of all banks in Europe, but they have increased massively with rate rises across Europe. But of course, the flip side to that, of course, is interest rates now going down. So the question becomes, what will happen to Commerzbank's earnings going forward? And frankly, they're probably going to be going down. And therefore, that's where the pressure on them will lie. So are they getting a good deal, or are they paying almost at the top in terms of their earning potential?
What company would that make UniCredit? Like, would this be a giant investment bank and a giant retail bank?
Well, they will become the third largest European bank if they did the deal in terms of on a market cap basis. Obviously, Commerzbank is almost entirely now a retail and commercial bank. It sold all the investment banking operations it had after the financial crisis. So this is very much a case of expanding in terms of that retail commercial space. UniCredit have a big presence in Germany already through Hypervereins Bank. So one of the attractions to the deal for them would be combining that, say, Commerzbank and Hypervereins, and therefore trying to get the cost synergies out of them. But say it's very much on the commercial retail side rather than investment banking.
So, Philip, talk to us about, just the German banking market. Does there need to be consolidation?
Does say yes. It's probably the least consolidated market in Europe in terms of, as you said, you've got this huge number of cooperative banks, the Sparkassen, etc. So it is a very difficult and diluted market. But the fact is, Commerzbank itself has got a sub 10% market share. So even if UniCredit did buy it and combine Hypervereins with them, they're still probably just getting over about that 10% mark. So will it change the dial in Germany? Not at all, because we're only talking in a 30% subsector in terms of the private banks, with 70% or so of the market, is in this mutual side.
So you were talking earlier that this has been rumored for 10 years. I remember talking about this at least 6+ years ago. Also, why do you think that now could be actually the moment?
Well, you asked also about what they get in terms of Commerzbank. We heard the CEO of Commerzbank said he will not renew his tenure, which expires at the end of next year. So that does open a hole at the top of the bank, which obviously be an attraction for them. So that's one potential way of doing it. Who would have bought Commerzbank given the excessive risks they had, say, 3-4 years ago, where we had, say, commercial real estate risks? We had the bank trading at 0.3 times book value. We had earnings of very, very low. So in a way, the risk has gone away a lot of Commerzbank because simply because the earnings are much stronger now because of those rate rises. Also, the German government took a big stake in the bank. So as they sell that further and further down, that's part of the way UniCredit built their stake today, that obviously becomes more and more attractive because it comes more into the private sector. So there are a number of small reasons why it could happen, but does it mean anything will happen? Then no.
Is this going to ignite maybe a little bit more discussion about more cross M&A trades, just broadly defined across Europe?
Without any doubt, it will trigger more M&A speculation today. And I think the fact that you said they built a 10% stake and yet the shares then rally 20% shows that the market doesn't think this is the end of the story. And there's going to be more of a deal and the potential bid for Commerzbank is possible. That said, why has there been no big M&A across the sector now for 15 years? And because a number of the regulatory hurdles remain. There's not a single rule book across Europe. Government interference, people don't want to leave their biggest banks and be taken over by a foreign institution, etc. All these hurdles, and nothing's actually changed on that front. So, no big deals have happened. Could this be the first? Yes, but it's by no means certain it will.
30 seconds. If the deal does happen, would the bank be able to lend more and do stuff?
I would have said yes 3 years ago, just because of the weaker financial position that Commerzbank was in. I think because of the rate hikes now, is in a much stronger position. It's got a surplus capital position itself. So there's no real barriers in terms of the supply side, their potential to lend more. What's restraining them from growing is actually more the weaker German economy. And we're hearing more about that over the press. And that's what's been holding them back. And frankly, nothing changes with this UniCredit deal there. Those hurdles still remain. So no, I don't think this will really help in terms of the lending or the growth potential. It's much more, I think, about the synergies in terms of the cost takeout potential.
Our thanks to Philip Richards, Bloomberg Intelligence Senior Analyst for European banks.
We now turn to big tech and Apple. Apple was the subject of a Bloomberg Big Take piece this week titled How Apple Rules the World.
It discussed how Apple ascended from a scrappy tech underdog to the most valuable company in the world. For more, we were joined by Austin Carr, Bloomberg News Technology Reporter.
We first asked Austin to connect all the dots for Apple from the 1980s until now.
You want me to summarize 40 years in a minute? I'm
You
happy
bet.
to do so.
You bet.
Okay, well, really what this story does is chart why and how Apple found in its position today, facing a big antitrust lawsuit in the US, a lot of regulatory pressure in Europe, as well as a lot of really just skepticism and criticism for a lot of the partners and developers that have depended on Apple over the years. And it charts how basically Apple has changed from that 1984 era when it released the Mac. It was seen as this sort of disruptive force in the technology industry to 2024, when a lot of people think that this is a sort of domineering force that needs to be disrupted. So we go through from the Mac to the iPod and iPhone up through present day. And it's just really just putting all the pieces together about how Apple finds itself in that position now.
And Austin, along with Max Chafkin, you guys reported this story, just fantastic work. But for me, Cameron Galley, who does all the illustrations, just made it really cool and really interactive, some awesome stuff as always. So Austin, where do you think Apple goes from here? Is it just new products? Is it maybe getting more ingrained in our daily lives, if that's even possible? What do you think kind of a longer term vision is for the folks in Cupertino?
Look, I mean, I think a really good question for listeners right now, or even you guys, is just this new iPhone. If you guys are Apple users, have you ever seriously considered switching to a different device?
No.
Or is it just the default now that I'm going to upgrade
Default.
to the iPhone 16, maybe a default? And so I think the question is, how long can that last, where it is just sort of the default? I mean, even their new features are all about, AI and how that ties in some of its hardware. But in all honesty, they're 2 years late to AI. A lot of the features Mark Gurman, our Apple colleague, is reporting that won't really release until 2025, at which point maybe you should just wait for the iPhone 17. And I just think there's a big question about, Apple's products are still good. They still make, the best laptop, the best, watch and earbuds. I'm talking through my AirPods right now. But at the same time, when they don't face that type of pressure, does their products just become too incremental and too boring? And I think that is when you're going to see a lot more disruptives trying to change the way computing works and work outside of the Apple ecosystem. But the problem for consumers like us is we're kind of stuck in it. I'm not going to switch anytime soon, for sure.
Well, then to that point, what I found also interesting, and I didn't know in the piece that you wrote, was sort of Tim Cook's role in managing Apple's supply chain. And you dug deep into Apple would have a supply chain partner and then in essence look to manufacture that in-house and then boot that company, which has really messed up tons of companies around the world. Can you give us some detail on that?
Sure. The most infamous example actually goes back about a decade ago. Apple was developing these new sapphire screens that were going to be ultra durable instead of the glass that they currently use. And they sort of outsourced it to a partner and then left that partner on the hook with all the liability when Apple decided not to go that route because the sapphire wasn't quite going as fast as they could develop it for the iPhone. And I think that we sort of position that as symbolic of what Apple has seen with a few of the partners they've worked with over the years, not just in the supply chain, but also on the software ecosystem side. It's really fascinating, all this sort of trend that we see of a partner really excited to work with Apple in the beginning, like Goldman Sachs on the Apple Card, or even General Motors, we cite as another example of working them on CarPlay. And then years go by and suddenly they're not so happy with the relationship with Apple anymore. And I think that really has become a trend in recent years as the company has grown to this massive multi-trillion-dollar force that essentially it's Apple's way or the highway. And I'm just curious how long that will last with partners before they say, you know what, enough is enough.
And, Austin, I think for a lot of investors, one of the longer term issues that's still always out there and is probably increasing in concern is just the regulatory risk for not just Apple, but kind of big tech in general, but certainly for Apple, given their marketing position. How do you think the companies how do they react to that? And just in terms of a long-term threat or headwind?
Well, actually, I mean, the DOJ case in the U.S., they just released their complaint in March. Apple has pushed to dismiss it just earlier in August. That's going to play out over the course of years. I think the preceding cases with the DOJ and IBM or DOJ and Microsoft, I mean, this lasts many, many years. But we're already seeing sort of a precursor to that in what's happening in Europe with the Digital Markets Act, which has already pushed Apple to change a ton. In fact, right now in Europe, because of those regulatory changes, you can get an alternative marketplace, meaning you don't just have to rely on Apple's App Store. You're actually able to delete a lot of native Apple apps that you can't delete in the US. You can delete Safari. You'll eventually be able to delete your phone app, your camera app, the App Store, and just use alternative products from the third-party ecosystem. And so what you're seeing in Europe is this almost two-track system where they have a lot more flexible sort of computing platform than anywhere else if you're an Apple user. So I think what they've sort of done is take this almost whack-a-mole approach to regulation in the EU, and even in some of the pressure they've seen in the US, they've had to open up that walled garden that as we refer to it, sort of their closed ecosystem a little bit more in a way that Apple doesn't like because they lose control. But for consumers, in a lot of ways, it's a little bit interesting to watch this company have to change and not just have it the Apple approach. They're going to have to, at least in Europe so far, open up their walled garden a little bit, allow some more players within their ecosystem to run some of those fundamental parts.
Our thanks to Austin Carr, Bloomberg News Technology Reporter.
Coming up on the program, a look at why activity in the carbon capture industry is starting to slow in the U.S.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We move now to the auto industry and focus in on Europe. German car makers are now sinking deeper into an industry-wide crisis.
This week, BMW warned that profits will get hit by a costly brake problem, and Volkswagen scrapped job protections that workers have enjoyed for 3 decades.
For more, we are joined by Micheal Dean, Bloomberg Intelligence head of global autos, and we first asked Micheal to dig deeper into why BMW lowered its expectations for the year.
So BMW had a profit warning, and that was partly on the back of a warranty issue it has with its brakes, not on the X3, so you're fine, Paul.
Good, no problem.
But they're going to have to recall 1.5 million vehicles, and that's going to cost a high 3-digit million in terms of earnings for 2024. But that doesn't tell the whole story, because they've downgraded their margin by about 200 basis points, which is about 2 billion of EBIT. So the balance of that is coming from weaker China sales, lower pricing in Europe, lower demand in Europe. So just the demand and pricing environment globally has been very difficult, and that's part of the reason for the profit warning.
Which then leads us to Volkswagen. So the latest news is that it's ending its job protections for auto workers in Germany as part of its cost-cutting push. These were several agreements that were linked to a 3-decades-old pact that was supposed to safeguard employment until 2029, but now those guarantees are going to run out by the middle of next year. I mean, wow.
Yeah, so, Volkswagen was in the news last week because it said it needs to close 500,000 units of capacity in Germany. So that's very difficult because of workers' rights. And, workers' rights have been very one-sided for Volkswagen in particular, because you have VW law. And this is where 20% of the ordinary shares, the voting shares, are owned by the state of Lower Saxony, which is where Volkswagen's biggest factory is. And funnily enough, they have the ability to block certain agreements. So workers' rights are very strong for Volkswagen employees. And now I think management are saying, okay, hold on a minute. The automotive world's changing rapidly. We need to do something to reduce costs. And part of that is to close factories and reduce jobs.
Michael, give us just a 30,000-foot view of the global auto business here. I mean, the weakness that you're seeing in Europe, the weakness you're seeing in China, is that just general economic weakness affecting that we've seen in past cycles, or is this something to do with this ongoing transition to electric vehicles?
Yeah, it's a bit of both. So, you have the transition to battery electric vehicles. It's going much slower than expected in Western markets. Other markets probably going quicker than expected, such as China. But the problem Volkswagen has is that the competition is so intense and has overtaken them in China, such as BYD. So Volkswagen a couple of years ago was the market leader in China. Now BYD, within 2 years, has overtaken Volkswagen. Mm-hmm. And really, it's going to be a survival of the fittest in these markets.
Well, I mean, these companies aren't going to go under or anything, right? So I guess I'm wondering when the trough is. When do we know? What is a trough actually going to look like?
Well, you say, a lot of companies could go under, particularly the pure play battery electric vehicle companies.
Sure, but I mean, I just meant that Germany's not going to let Volkswagen go bankrupt. Was my
question. No, of course. And the interesting thing, if you look at the valuation of Volkswagen, today it's valued at 45 billion euros. I've had a lot of clients talk to me about this. They have almost 40 billion of cash on the balance sheet. Their 75% stake in Porsche is worth 45 billion euros. They own Lamborghini brand, which has higher profitability rates than Ferrari, which is currently valued at 77 billion. So we think Lamborghini's worth 30 billion if you use a Ferrari valuation. So the sum of the parts is Volkswagen is huge compared to the actual valuation of Volkswagen at the moment.
So you highlight an area for me that just kind of feels like a long-term issue, which is China. I mean, they spend decades, they being any auto company, Volkswagen, BMW, Mercedes, whatever, building brand value and brand loyalty in a market like China. And in a period of 2 years, they've lost that, it seems like. I mean, is that the real bearish case for some of these global auto companies?
It's a big case. So for the German automakers, in the past few years, China was the most profitable market. It accounted for 35-40% of their profits. Now, this year, it could be as low as 10%. And what the market's pricing is that could be zero in the future. And that's because the technology changing and the way that startups in China are pushing through so quickly. They're really fighting for market share at the moment and their future.
So then it goes back to my question. What does the bottom for either U.S. car companies or for European car companies wind up looking like as the tariffs go into place, as China keeps producing these really cheap EVs, as we have different restrictions here in the U.S.? Like, what is that?
Well, you look at what GM and Ford have done. I mean, GM in particular, it's looked at different markets, and if it's not profitable, it's pulled out of those markets. Right. So China is one example, Europe's another example. So it's whether the German automakers take a view that can they be profitable in China in the future. And many foreign car makers are saying no. Volkswagen at the moment is saying yes, we can, and they've got this long-term plan, and they've invested in XPeng to hopefully accelerate their transition. But it's going to be very, very difficult for foreign car makers to continue to make profits in China.
So, I mean, again, it feels like, is there even discussion of whether they should be there at some point?
Certainly within the market, but for the company itself, that they've invested heavily in China. And they've got a plan now to try and catch up with local producers, to catch up with BYD, which is with this partnership with XPeng. So they think they've got an opportunity because they've got a good brand in China, but it's going to be very tough. I mean, pricing in China is really, really competitive at the moment, to the point where battery electric vehicles are actually priced below internal combustion engine vehicles. Wow. Compared to that to Europe, where the average battery electric vehicle is 35% higher than a ICE vehicle, and they still can barely make a profit in Europe. So that's it's amazing, a very tough environment.
Our thanks to Micheal Dean, Bloomberg Intelligence, head of Global Autos.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance. They're the team in Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at carbon capture. After 2 years of consecutive and dramatic growth, activity in the carbon capture industry is starting to slow in the U.S.
For more, we are joined by Brenna Casey, Bloomberg BNEF carbon capture analyst.
We first asked Brenna to define what carbon capture is.
Basically, simply, CCUS, carbon capture, utilization, and storage, it's kind of just a way to abate emissions from heavy industry. So things like petrochemical refineries, integrated steel mills, hydrogen, blue hydrogen. Natural gas processing is a huge historical end-use sector.
So basically, there's some sectors that you cannot decarbonize, and they have to exist, like you need cement, for example. So this is a way to kind of get them out of the air, and then the question is kind of what do you do with it? Do you reuse it somewhere? Do you put it somewhere? Do you store it in a rock or somewhere else? And it's been a huge focus for a lot of companies, energy companies and alike, and oil companies, for example. What has been the investment cycle like, and where are we now in that cycle?
Yeah, so if we're looking particularly to the U.S., following the Inflation Reduction Act, we saw this catalysis of not only project announcements, but kind of, Series A, lots of equity financing into that, into the market. Right now, as, the IRS has still yet to address 45Q. So that's the Inflation Reduction. So the Inflation Reduction Act, which was signed into law, 2 years ago. 45Q is an investment tax credit that the government is proposing to, heavy emitters. They can, if they meet XYZ requirements, then they can take this credit and apply it to their tax burden, and, kind of helps to mitigate the cost of CCS because it's extremely CapEx intensive.
So if you store your carbon or get it out of the air, you get a tax credit.
Okay.
It's like $85 per ton if you store it, and then $60 if you utilize it. Yeah, exactly. However, the IRS has yet to finalize the criteria, so developers don't know what actually constitutes as a project that can qualify for these sorts of credits. And so what we've actually seen is not only investment taper off, but just announcements of future projects into the sector. What's kind of ironic is that if we look at investment numbers for last year for CCS in total, it was globally 11.3 billion, higher than it's ever been before. The U.S. took home around 2.8 billion of that. However, that is all bolstered by just DOE grants. So the DOE has these direct air capture hubs. They're trying to throw money at growing out midstream infrastructure, so transport like pipelines, the storage like storage basins you mentioned earlier. But there's really no FIDs being taken in the sector at all. Besides, I think it was the hydrogen Beaumont complex last year.
So FID is foreign investment decision, final investment decision,
yes.
sorry. And it basically means like, okay, I have enough and I understand enough of the economics where I can actually like put money in the ground and like put a shovel in the ground and do some stuff. And that's where we're really lacking, which raises the question, is it building the stuff is still too complicated, or is it the demand side? So I'm a company and I'm like, I can capture your carbon and I can store it for you, but how much are you willing to pay for that? Is that part of the issue now?
Yeah, it's definitely kind of a sector by sector issue. So if we look to power, we're seeing the most cancellations in the power sector just because CCS is tremendously expensive. And so if we're seeing a project announced, around 30% of those projects in the power sector are like, they're probably going to get canceled. And that's because retrofitting with CCS adds around 56% to the total LCOE. So it's 800 million plus CapEx investments. If you look to something
which
like...
also then, how do they recoup that? Because
Exactly.
about power, it's either the company's paying for it or like I'm paying for it in my bills, right? And that's a different way of how they recoup that cash.
Especially if, the 45Q credit, if you are an emitter to qualify, it only lasts 12 years. A lot of these lifetimes are 20, 25 years. And so, yeah, how do you kind of make that investment back?
Carbon capture losing some momentum because maybe just the transition to green in the U.S. has become a little politicized and maybe it's losing a little bit of impetus? Are we falling behind other countries, for example?
The U.S. is definitely the market leader. So globally, there's around 424 million metric tons of CO2 capture capacity due to come online by 2035. Now, out of that, around 163 million tons is based in the U.S. And following, the 45Q, Inflation Reduction Act, even though there's, hiccups here, hiccups with transport and storage permitting, we do see the United States as the best place in the world to kind of build one of these projects.
So what companies do you feel like have the real deal? Because I talk to a lot of companies and they're all going to try and sell me their carbon capture products and why they're the best and how their economics work and all that stuff. Who actually can make this work?
Yeah, if we're looking at power and hydrogen, which are the two leaders right now, kind of the biggest players here, we're seeing Occidental Energy. So not only are they looking to retrofit their, natural gas assets with carbon capture, but they're also kind of taking this first mover run into the direct air capture space. So that's a really interesting company to watch in that kind of little corner. There's also, air products for hydrogen. ExxonMobil, it's primarily these oil and gas majors that are moving around in the market because they have, just previous expertise, but they also understand the geology, how to store these things, how to build, these big, expensive projects. Air products, Oxy.
Our thanks to Brenna Casey, Bloomberg BNEF carbon capture analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.